Hi, good morning, everyone. Thank you for joining us today. In this episode of the Money Talk Silicon Valley, I have Barbara Hart, 37-year veteran of the residential mortgage lending industry. And we're here to talk about, is it a good time to invest in real estate, and what are some of the updating trends in the mortgage lending industry. How are you doing, Barbara? Thank you for joining us.
Doing great, thank you.
Awesome. How's it going out there in Bend, Oregon?
Oh gosh, it's a gorgeous sunny day and lots going on. It's a Monday.
Yeah, I bet. Keeps you busy, doesn't it?
Absolutely.
Awesome. So, obviously there's some quite historical times if you think about it with everything else that's going on. 2020. A lot of people have high hopes, and now it's turning out to be such a different thing that everyone have experienced, have expected.
Right.
I talk to a lot of people. They say, "Man, if they can unplug 2020 and have it start over, and that's what I'll do."
Oh, I'm ready for a reboot.
Oh my God, what a difficult time.
It's unreal. It's crazy.
Yeah, definitely. So now, giving with all this shelter in place, working from home. So now, from mortgage lending perspective for you in your industry, so what trends, what new trends are you seeing? What market updates are you seeing because of COVID?
Well, first of all, coming to you from Command Central here at my dining room table.
Right.
That's the biggest change here. And honestly, we haven't skipped a beat. We're just working. Everybody's working remote. We're working harder than I think we've ever worked, mostly because we can't get away from it. We, get our cup of coffee in the morning and that's it, just
Yeah.
boom. But and along that line, I'm seeing that people are, because they're able to work from home and work remote, a lot of companies are just kind of re-examining, gee, do we really need the workforce to come back to work? This is working out pretty cool. And what that's doing is creating another whole situation where people are realizing that they don't necessarily need to go to an office. They can work from wherever and be very effective at their job. So what we're starting to see is a huge exodus from more populated cities and more populated suburban areas. And people are starting to realize that they have a choice where they can live and create the lifestyle that they're looking for.
Yeah, funny that you say that, because I too am working from home, right? And I'm looking at my kitchen right now, and I just made coffee, and I just the commute from my bedroom to my office is literally just 10 yards, and that's just fantastic.
Yeah, it's hard to get away.
I go shopping, I look out on the highway, and I'm like, man, there's no traffic. It feels, sitting in traffic and driving to a client's office, or having a client calling me saying, I'm delayed, there's an accident on the traffic. It seems like it's such a distant past. But I am very glad that it is in the past. So it's fantastic. That's
Absolutely.
awesome. Yeah. So people are seeing that they're, are you saying that, even companies are like trying to figure out ways to have people working from home longer, and that people are actually discovering that they can actually live in an area that they really want to live in, like out in the wilderness or out in the woods, have a much better living environment, and at the same time, getting work done.
That's really true. And they're seeing that they have a lot more options.
Yeah.
And honestly, this is really giving people an amazing reset opportunity, an opportunity to step back and discover what it is that's important to them, and then how to frame up a lifestyle around that. If you can work remotely, if you can work from anywhere, where would you want to live? What would you want to do? So we're seeing a lot of people moving up here to Bend, Oregon.
Yeah, well, you spent majority of your career here in California, and you and James have made the move to Bend, and and you're seeing other, maybe is there other people from Bay Area, going to Bend, to your area?
A lot of people from California, people from Texas, people from all over are coming here to visit. They fall in love with it, and then when they can make that choice, it's definitely on their radar. We're seeing a huge uptick in demand for housing.
Yeah, that's changed the market in there. In fact, I don't know if I told you, but my family and I have actually just bought a new house in Aromas, which is about
Yeah.
an hour south of Gilroy. Right now, we're living in a much bigger house and much better environment. I can see the Monterey Bay from my window.
Oh, it's a
And
beautiful area.
the sea, get that sea breeze, and it's such a beautiful place. And at the same time, I got to talk to people like you and get work done at home. It's such a beautiful
That's pretty
process.
groovy.
Yeah, awesome. So is this a good time to be investing in real estate in some of these areas then?
Well, here's the thing. Housing is one of our most basic needs, and it creates a degree of certainty in our lives.
Mm,
And then how can we expand on that certainty is to basically own our home
yeah,
with a fixed rate loan. Because if I own my home, I'm not going to raise my rent and I'm not going to evict myself, right?
yeah,
So the idea is to create as much certainty as possible around that. And what I'm seeing right now is the combination of people leaving a lot of urban areas and coming to places that are less populated. We're seeing a demand for housing that's huge,
yeah,
but we're also seeing record low interest rates.
yeah.
So
Tell me
the
about that.
combination is just like the increasing the buyer's buying power.
Yeah.
It,
So
it,
tell me
it
about
has,
the interest rates. We just, I remember that we used to get like 4%, 4.5%. That used to be a pretty good interest rate. Now, what are the going rates now?
I remember when we thought that it was never going to get down to, single digits.
Yeah,
And then,
right. Yeah,
but
back in the
now,
80s, man, it was double digits interest rate. I can't even imagine what that must have been like, for someone on my own.
it was pretty crazy.
Yeah.
But one thing is that there's always going to be people that are buying and always people that are going to be selling. And then it becomes a matter of affordability. It
Mm.
becomes a matter of buying power
Yeah.
and how to keep that monthly payment down and increase, again, keeping with the theme of certainty, keeping that certainty in your life of knowing what your monthly overhead is. I have closed transactions for buyers as low as 2.75,
2.75%. Oh my God. That's free money.
2.95. Oh yeah, it's
Yeah.
crazy. So below 3% is definitely in the realm of things. But of course, everything depends on each, client's situation, their individual situation, their how we structure that. So that doesn't mean it's not one size fits all. That's for sure.
I get asked these questions a lot. People ask me about, is it good to pay off debt, or is it good to carry a mortgage, or should I just pay it off on 15 years, or what should I do? And I always ask them, I'm like 2.75%. So let's think about the real cost of borrowing, right?
Right.
Because you're in a 30-year fixed mortgage, that the money that you pay on a monthly basis is the same for 30 years. 30 years. But the money is not the same in 30 years. The purchasing power deteriorates over time, right? So if you think about inflation, this phenomenon of inflation is deterioration of purchasing power, right? The stuff that we always talk about, loaf of bread, it used to be $1.50 or or whatever. Now it's like $3 or $4. But see, inflation works in your favor when it comes to real estate, because the real cost of borrowing is the mortgage rate that you got to pay minus inflation, right? It's the same money that you pay for 30 years. The guy that loaned you the money for 30 years, he's still getting 3,000-4,000 a month from you, and in 30 years, that's not nearly worth as much. So I mean, at 2.75, I would imagine that's just an amazing opportunity for a lot of people. So now,
It is.
I've oftentimes people talk to me about the challenges about buying real estate, getting into getting into the real estate market, especially for first-time home buyers. They're living a big lifestyle here in California, in the Bay Area. Everything's so expensive, and they're just finding it challenging to actually save for the down payment. And now, are we still our mortgages still requiring 20% down payment from the federal government? The lending guidelines still requiring 20%, or is there other options that may be available for people?
Actually, with all due respect, never has required 20%. And that's one of the biggest, that's one of the biggest misunderstandings that people have
Really?
is that they have to have 20% down. Well, it's always been the biggest challenge is coming up with the down payment.
Yeah.
That is the biggest challenge. Once you get that snowball rolling and you make your first investment, grow the equity and move on to the next one, it's always just getting that initial transaction, that initial house, the first house. So it's always about the down payment. So we can do loans as little as 0 down.
Really?
Up here, we have USDA loans in outside of Bend, not in Bend proper, but in the Bend area. We have USDA loans that don't even require a down payment. There are very strict guidelines as far as who can qualify for that. But and then moving down from that, 3% on a conventional, 3.5% down on FHA. And again, it depends on the client's individual situation, their credit profile, and everything else that way as to what the best loan structure is for them to meet their needs.
Wow. So is mortgage insurance still a thing for loans that are below 20% down payment?
Absolutely. And that mortgage insurance insures the lender against the borrower's default. So it benefits the lender, and it's necessary to protect that top part that they're not putting the 20% down. Okay. So that's what it does. Now, there are some very cost-effective ways of structuring the mortgage insurance so it's less costly to the borrower. And so a lot of times just a single premium that's added onto the loan balance, and then you're paying the lower interest rate on that.
Really?
That usually works out better.
You can amortize the whole thing over 30 years. It's a single premium. Oh, that's fantastic. That's a great option.
It actually is. That's a great way to structure it. But again, it depends on the individual situation. You got to price out every single situation and every scenario.
See, I'm so glad I'm talking to you about this, because just last week I was working with a new client, and he had, and I give him the advice, to have a 20% down payment, and we were looking at the roadmap of having.
Not in today's. Nope. Keep your money.
Oh man, yeah.
It's all about cash is king.
Cash flow also, right? So he's making really good money, but of course, like everyone else, saving the money is always a challenge. So I actually told him. So we actually put together a roadmap to be having him saving money in the next 6 years, so that he can be having a 20% on a $1 million home here. So then from what I'm learning from you this morning, actually there are other ways to do this.
Well, there are, and I think that if a person can get into the homeownership in less than 6 years, and there's a way to do that with putting less than 20% down, but staying within the borrower's comfort zone of that monthly payment. See, that's the balance that you have to do. You have to be in the comfort zone of the monthly payment, and maybe looking at some other alternatives to generate that monthly payment, to generate the down payment.
I really like the idea. I really like the idea of putting the mortgage interest premium into the loan itself and amortize out of it 30 years. I think that's a great way to do it.
It is, but another thing to explore is other family members that might be willing to give a gift, and that might be in the form of early inheritance or whatever that looks like, or possibly, as you're looking at, obviously, the investment side of things. But then also, is there somebody that would like to own with him? Because we do also with non-occupant co-borrowers, and what that means is somebody that wouldn't necessarily occupy the property with him, but they would also have their credit and their down payment perhaps go towards the property, and then that they could get into the property in less amount of time.
I see.
Because if you can take advantage, I know one thing, with record low rates, where are they going to go? They're going up.
Yeah.
Don't know when.
Right. You're right.
6 years, I can pretty much guarantee that those interest rates are going to be quite a bit higher in 6 years than they are right now. So if
Absolutely.
there's a way for him to get into that and take advantage of those low rates, the lower rates rather, in the next year or so, that'd be great.
That'd be really good. So, like a non-occupant co-borrower, that would be someone that is someone whose name is also on a loan, but not actually living in the house. It's like a parent or a sibling that has a really good credit. That can help. That can help with that. Now, are they also going to be on title in that situation?
Yes, they
I
can
see.
be. Hmm.
I see. Okay. Is it
Yeah,
required?
if you're on loan, you're on the title. And
I
then the reverse is also true. Sometimes it's better to have a spouse or somebody else that's contributing towards that not be on title. Or excuse me, be on title. I said that the opposite way.
Yeah, to be on title as well. Okay,
Yeah,
got
be
it.
on
Yeah,
title but not on the loan.
that's a really good option, actually. I need to have another conversation with my client and have them call you because I'm already learning all these different options that I didn't know was possible for people.
Well, and I think that's the main thing is that would be the main point would be it's better to have a conversation sooner rather
Right.
than later and get that planning in place, just exactly like what you're doing with your client.
Yeah,
And there goes the clock.
got it. Sign. Awesome. So now let's talk about the do's and don'ts, right? So if someone is getting themselves ready to purchase real estate, right, and what are some of the things that you always coach your borrowers, your buyers? What are some of the things that they should be doing? What are some of the things that maybe get a second opinion or reevaluate what they're looking to do? What are some of the do's and don'ts in this area?
Well, I'd say the biggest thing is kind of like what we were just talking about is everybody has an opinion.
Mm.
All of your friends and well-meaning family, they all have an opinion.
Yeah.
And there's a lot of misinformation out there, and our situation is always changing.
Right.
And I think it's really important to have a discussion with a professional, whether or not, if you're looking to purchase a home. I don't care if you stay in my file drawer for a year before you buy. A lot of clients do. And a lot of clients learn that, oh gosh, I didn't know I was really ready to do this.
Mm.
And so they're ready to move forward in a shorter period of time and way quicker than they ever dreamed.
Yeah. So everyone's got an opinion, but
Yep.
not all opinions are equally valid. And
That's true.
a,
Got to talk to a pro.
a business coach told me something that really along those lines that stick with me it was really impactful for me because at the time I was really struggling and just looking for direction for myself. And this coach taught me that opinion is the lowest form of human knowledge, as that it requires no verification, no evidence, no science, no research, and none of that verification. Anybody can have an opinion, right? Just
Right.
because you have an opinion, it doesn't mean it's equally powerful, equally valid. So be mindful of the well-meaning relative opinions and talking to a professional, and maybe having a personalized approach towards what you're looking to accomplish. Yeah.
Absolutely. And I tell all my clients, the unfortunate truth is I'm not going to be making their payment for them.
Mm-hmm.
Right? At the end of the day, they're the ones making the payment. So the decision is 100% theirs.
Right.
And I'm just here to ask questions and to gather information, come up with possible solutions and ideas, brainstorm different ways to get the job done.
Right.
But at the end of the day, they're the ones making the decision because they're the ones that know what it is that's important to them and what it is that keeps them awake at night. And we want to solve problems, not add to those problems.
Yeah, absolutely. That's words of wisdom. Let's talk about personal debt and other situations. I often get asked for people when they're saving for a down payment, for example. They always ask me, should I, I've saved some money now, and I know that the debt to income ratio is a requirement for mortgage lending. Now, should I be paying down debt? Should I be saving towards the down payment? What should I do? And I always get asked about that. What do you think?
Well, kind of piggybacking on what we just talked about a minute ago, every situation is different, and advice to one client would be different than advice to another, because sometimes people have to pay their debt off to be able to qualify. But the biggest challenge for most people is saving up that down payment. So there's a delicate balance there. And there's ways to reposition your debt if maybe you already own a home and maybe you want to reposition your debt, reposition your assets. And it can be life-changing, you know, in terms of a refinance as well. So that's very, very important to take a look at how can we increase the cash flow, because with the increased cash flow comes choices and lifestyle. And increased cash flow comes certainty. Certainty that you're saving money for the kids' college, certainty that you have reserves, certainty that your overhead is lower, etc. So there's just so many different answers to that question. And I think in terms of paying off debt to qualify versus having the down payment, again, back to the individual scenario and running those numbers.
So there really are a lot of moving factors, and every debt is structured differently. So there may be advantages in one way or the other to pay down debt or to maintain it for now. Okay.
Oh, absolutely. And I just recently had a client who paid off a whole bunch of medical collection accounts right before she met me.
Yeah. Sounds like the right thing to do.
Sounds like the right thing to do. And it really, in a lot of sense, it is the right thing to do, but not when it comes to your credit score, because it has a devastating effect on your credit score.
Really?
Because of the way that the credit algorithms see the a collection account, it becomes the date last reported becomes the payoff date. And then that has a negative impact on the credit score.
So the medical debt, because of the payoff, actually became a recent debt or recent settlement, and that actually had an impact on
whereas before those collection accounts were 3, 4, 5 years old.
Right.
And so they didn't really have a huge impact on the credit score.
Right.
But when you pay them off, all of a sudden the date last reported gets renewed.
Well, that's critical. That's critical for somebody that's looking to buy, borrow a large sum of money and buy real estate, because we all know that the credit, this credit score, besides the rate that you get, so the better the score you get, the lower the rate that you would have, and you literally translate into saving tens of thousands of dollars over the lifetime of the loan. And the credit score is calculated based on, number one, the on-time payment history. So if you actually pay off debt, and the settlement date actually become a recent default
right on a collection account.
Oh my goodness. Yeah, that would be detrimental. So that's a perfect example of well-meaning gesture, right, to reduce debt. Could actually lead to detrimental effects in the mortgage lending situation.
It certainly can.
Yeah, thank you for that. That's a really valuable advice. I can only imagine there are countless many other examples that you probably have seen over your 37 years working in the industry.
Well, yeah, and back when I started, we didn't even have credit scores. We just learned to read credit reports and evaluate clients based upon their credit history.
The real
underwriting. It doesn't just give you a score as the yes we can, no we can't.
Yeah, I got it.
But the other thing is that, again, it's just such an individual thing. And just to be super clear, I am not credit repair. I do not do credit repair. That I'm not licensed to do credit repair. I have other associates that I refer my clients if there's things that they need to take care of, that we can help them that way. But just to be super clear, we're not licensed to do credit repair.
Well, you're gonna have to refer me to someone that I'd love to bring that person on this on Money Talks Silicon Valley to have a conversation about credit repair, because I met a lot of people, they have inadvertently, right? I mean, just wasn't paying attention to how important credit actually is for them. So they're in a 620, 640 range, 650, which with a few things that I already know how to do, they can quickly repair that into the 700s, which will make a huge difference.
In many cases, that's true. And in some cases,
yeah, I'd love to talk
where it's all individual.
on this channel. So Please introduce me. So now, let me ask you this: if I am already a homeowner, you know, I live in Silicon Valley. You know, if I'm already if I already own a home, is this a good time to refinance?
Absolutely.
Yeah.
And I'm just saying, and I say that, to investigate whether it makes sense. Yes.
Yeah.
It's a fantastic time. And I think I mentioned earlier, in some cases, I had a client tell me recently that they thought it was life changing, the amount of
Really?
savings that they were able to attain. It's life changing with these lower rates. And a lot of people don't realize what a big savings it can be between what was a great rate 6 months ago, 3.75 or 3.5, down to as low as 2.75, 2.85.
Yeah.
It can be life changing. And again, sometimes it's a 2 or 3 stage approach, depending on what it is we're trying to accomplish.
Right.
And so if we do a cash out refinance to pay off a client's debt the first time around and just get them out from underneath that in itself is a great transaction. And then months later, if the rates hold or drop, then we're able to refinance and drop that rate again. And I've done that. I've helped several clients this year more than once. And this is August.
Nice. Fantastic. Well, I'm so glad I spoke with you this morning. You've given me a lot of ideas. You know, I'm just, as you were talking about this, it's just a list of people's names just coming to my mind. I was like, man, I better bring this, conversation to these guys and really invite them to have a conversation about, mortgage and, what you can actually do to help them improve their cash flow, improve their financial position. So thank you.
That's the name of the game. That's what floats my boat.
Thank you. Thank you very much for
really
that. And thank you
helping
for spending
people
some time.
to optimize their finances.
Yeah. Now, before we complete, do you have any other words of wisdom for our audience?
I would say the biggest thing is to really get with your financial advisor. That would be hopefully Peter.
Yeah, absolutely.
Hopefully you. Oh wait, it's the opposite. Hopefully you.
Oh, I don't even know where I'm going.
Yeah, no. Get with your financial advisor and get a plan going. Talk to your favorite mortgage lender and just get some straight scoop. And one thing I know about both you and I is that we are our clients' advocates. If it's not in our client's best interest to move forward with something, they may not want to hear that, but we're going to shoot it straight. And that's why we work well together.
Yes,
It's
I absolutely
our
agree.
client's best interest at heart at all times.
So, Barbara, I'm glad that you mentioned that because, the purpose for my work really is to make sure that the people that I'm working with don't fail, right? That they reach the goals that they set for themselves, and that they fulfill the promises they make to their families, and then they realize the dreams and aspirations that motivates them to get up every morning, go to work, and make money, right? So that really is the purpose for me and my work and my company, Wealth Can. So that's very, very well said, and I couldn't agree with you more.
Excellent.
And so thank you again, Barbara, for being here with us this morning. I myself have learned a tremendous amount of information from you over the years, and thank you for supporting me all these years and my clients. So
my pleasure.
Yeah, absolutely. So thank you everyone for watching, and I hope you learned some valuable information. And thank you for spending time with us. I'll see you again next time. Bye now.
Thanks. Bye-bye.